Sweet gains or spicy challenges ahead. That's certainly going to be the theme of today. It's going to be a little of both. Last month we did my bull market buzzkill, giving you all the reasons why I think things longer term are looking a little bit shaky, a little bit iffy. But that's really not until the second half of this year, maybe early next year. But for now, we're just looking at seasonality things. We're looking at money flows. We're going to look at why Philadelphia winning the Super Bowl maybe was bad for the market, but that's more just because it's funny. We're going to look at the presidential cycles again, see where we are at. I'm actually going to revisit a couple slides that I did show last time just to see how things have progressed in that time frame. And then we're going to look at the current money flows. And then the last thing is kind of fun, a tweak on the RRG, which is relative rotation, which we often refer to as the ducks going around the pond, a way to look at that both by headings and giving another way to give a heads up of how the market is shifting. And that's going to be kind of cool. And that's at the end. So let's dive in. Okay, why America wanted the Chiefs to win? Because when Philadelphia wins a World Series or a Super Bowl, bad things happen. Okay, first of all, we don't ever suggest investing based on who wins the World Series or the Super Bowl. It's just interesting. So the last time the Eagles won the Super Bowl, which is apparently 2018, was the worst year for stocks since 2008, which was the financial crisis. Now in 2008, a Philadelphia team won the World Series, and that was during the financial crisis. And then you go back to 1980, they won during the 1980s double dip. That was before the market took off, which wasn't until 82. And then 1930 was the Great Depression. How about that? And then 1929, the crash of 29. How about that? Bad things happen when Philadelphia wins. So let's hope that is not the case. Although my bear market case does push out for next year. So I'm going to hope it doesn't show up early because they won the Super Bowl. It's just trivial and funny, but I had to share it. Too good. And that's, of course, my friend Ryan Dietrich at Carson Group. All right, so the first quarter of the year of the first presidential cycle is usually weak, and it is weak as expected. It's not bad, but not as good. The market peaked somewhere around December 16th, I believe, last year, both the S&P and the NASDAQ, and then sold off in December. So January was a rebound of that, but it's not really making new highs. We're nowhere near making new highs, actually. So we've had a rebound, and it feels like this year is good so far, but it really is just retaking what was lost in December. Not a huge positive. It's not bad. It's just neutral, and a couple factors showing that the first quarter of the first year of the new presidential cycle is usually pretty weak. And then seasonality, let's dive into that, shows that usually in that same reasoning, that first year of the presidential cycle, the second half of February is ugly. And it's not just then. It's almost every time, every February tends to be this way. The first half is just kind of choppy, and the second half can get very ugly. Now, that doesn't mean it has to happen. Nothing has to ever happen. But it's a good roadmap to say, okay, this could happen if we start seeing that play out, then we're going to get more defensive. And then we actually have already gotten defensive to some degree based on the money flow stats I'm going to show you later. But what typically happens is after the market sells off in February, you get a choppy March. And then, as it showed before, the second quarter, which is April, May, June, should be pretty good. And that historically does match with the seasonality. If we get a good pullback in February and into March, that should be a great setup to be very aggressive into April or May. And that gets into that sell in May, where the middle portion is, or the third quarter is kind of iffy, and then fourth quarter is great. Back, and that's pretty typical, bottoming in sometime September, October, and then having a good run into the end of the year. Go back to this slide. Q3 is kind of iffy. Q4 is pretty awesome. And that's pretty typical of how the market just runs cyclically over the year. So those are things that we are keeping in mind. From a money flow standpoint, we're above the 55 moving average. We kind of keep this as how reasonably safe is it based on is enough money coming into the market to justify it going up or not. And if it's above this line, it's usually pretty good. Of course, since that December peak, it did get iffy there for a while. It did regain to be above the moving average, but it's just it's not really going anywhere. The market's really good when you get these runs up, and then we're just not seeing those runs up. So I'm very neutral in the market right now. Then we zoom into the shorter money flow. We actually turned negative yesterday, and we now have these dots to kind of show when it's pulled off far enough off a peak, both the bottom and the top, to say, okay, this is where we probably want to start looking at backing out and seeing why the market might be a little bit sketchy here. And if market money is coming out of the market, that usually precedes an uglier market. It doesn't always have to, but it's certainly a good heads up. Volume and money flow does lead the market probably more than anything, because people vote with their dollars based on what they're invested in, and that kind of drives things. But it tends to get the heads up early on this to say, hey, things might be a little bit iffy, and this is confirming that. Now just like here, it could reverse here tomorrow, and be great. And then never mind, we're going to be off to the races. We'll get more aggressive to match that. But for now, again, this is backing up that thesis of the second half of February might be a little bit sketchy. And this is actually backing it up. So we could see this drop like it did back in here, but then that's fantastic because then we can look for this new entry dot to say, hey, this might be the weakness is done, money is starting to come back. Let's see if we can catch this next wave. And I'm looking forward to that. I think this has really helped give us an early warning or a good early signal of something changing than we had before. Of course, the positive negative sectors, we're 5 to 8, 6. This has just been kind of meandering, nothing exciting. XLP is consumer staples, and that's the only one trending up, and that's a defensive one. You don't want to see that leading, again, with utilities and healthcare, right? These are all mostly defensives. XLC is the one exception. XLC is somewhat tech, and that's doing okay. But for the most part, the defensives are leading. All the aggressive stuff is not, where XLY is consumer discretionary, and that's largely like Amazon and Tesla. Technology is weak, although it's trying to come back. It's just not back over there yet. Industrials, energy, etc. Again, agrees with it's not a positive situation to have the defensives being where the strength is at this moment. So we'll have to see this play out. But it's all falling into place as to what I would expect based on the seasonality. And based on that, we are getting defensive. Everything here was in the green leading. As all the sectors kind of fall into weakening, that's usually where the market starts to get weak. And then when they push into lagging, that's when the sell-off is happening. So this is really a really good heads up, even though interestingly, tech is kind of trying to make a comeback. XLC, which is communications, is another type of tech, is doing okay. But most of these are just kind of meandering in this weakening box, which I don't love. So this usually precedes this, watching the ducks go around the pond. They go from weakening to lagging to improving to leading. So what I'm looking for is for these to come into lagging and then to start turning upward. This goes into my next and final slide of when these start to move, when they're down here and they move up and to the right, which would be north and to the northeast from a heading standpoint, that's usually when things are starting to improve. It's a good early warning of things improving. Just like up here is when they're doing well and they start going south and west, that means there's probably an early warning that something is not going right. So then now we're looking at all the sectors and getting their headings. So we know which ones are moving north and northeast. This is east. This one just turned south, right? So straight down. So it's about to go southwest. And then these last two northwest, meaning they may be turning back up soon. So these are the ones that may be leading us back out, which is industrials and energy. So that's just a neat way another way to look at this grouping to understand how they are moving in the cycle. And when you watch all the pieces of the S&P, because that's ultimately what this is 11 sectors that make up the S&P. So if we watch all the pieces and they all are moving together, we can kind of understand where it's going to go and where it is in that cycle. So again, another way to watch the ducks go around the pond, and I'm finding this very useful.